Alright, welcome back to the channel, everyone. I'm Murph, and as always, I'm here with the man who stares at charts until they reveal their secrets, Cooper. And today, folks, we're tackling the big one. The Holy Grail. The question I get in my DMs literally every single day: what is the single best trading strategy? The one that just works. The one you can use on Bitcoin tomorrow morning and on Apple stock in the afternoon. We're going to build it from the ground up right here, right now.
And right there is where we need to start, Murph. With a healthy dose of reality. Welcome, everyone. It's great to be here. The idea of a holy grail, a single strategy that never fails, is probably the most dangerous myth in trading. It leads people down a rabbit hole of chasing phantom signals and blowing app accounts. So before we go any further, let me be crystal clear. Nothing we discuss here is financial advice. We are not certified financial advisors. This is purely for educational and entertainment purposes. Our goal today is to give you a framework, a robust methodology for thinking about the market, but what you do with that information and your capital is entirely your own responsibility. Please do your own research.
Absolutely. The disclaimer is paramount. We're giving you the blueprints, but you're the architect of your own portfolio. But let's be real, Coop. People are tired of the noise. They see a million different indicators with the Bollinger Bands, Ikimoku Clouds, stochastic RSI. It's like a cockpit in a spaceship, and they don't know which button does what. They just want a system that makes sense, that's repeatable, and that filters out that noise. That's what we're promising today, right? A filter.
Exactly. A filter is the perfect word. We're not inventing a new, magical indicator. We're not claiming to have a secret formula. What we're going to outline is what I call the Confluence Method. It's not about relying on one single thing. It's about waiting for several, logical, independent factors to align and point in the same direction. It's a strategy of patience and probability. It's built on three core pillars that have worked for decades across all markets because they are based on the unchangeable principles of market psychology: trend, momentum, and volume.
Trend, momentum, and volume. Okay, I like it. It sounds simple, but I have a feeling the devil is in the details. So, where do we start? Pillar number 1, trend. How do we, with a high degree of confidence, look at a chart and say, okay, the bulls are in control here, or the bears are driving the bus?
It's the most fundamental question in trading. And the simplest, most effective tool for the job is the moving average. A moving average, or MAR, simply takes the average close-in price of an asset over a specific number of periods and plots it as a line on your chart. It smooths out the chaotic, day-to-day price action and gives you a clearer view of the underlying direction.
Okay, so I've seen these on charts. You have the SMA, the simple moving average, and the EMA, the exponential moving average. What's the difference, and which one should we be using? Does it really matter?
It does matter, subtly but importantly. A simple moving average gives equal weight to all the prices in its calculation period. So for a 50-day SMA, the price from 50 days ago matters just as much as the price from yesterday. An exponential moving average gives more weight to the most recent prices. This makes the EMA more responsive to new information and recent price changes. For our purposes, because we want to react a little more quickly to shifts in market sentiment, we're going to use EMAs.
More responsive. Got it. So, what EMAs are we putting on our chart? Are there magic numbers? The Fibonacci sequence guys are probably screaming 21, 55, 89 right now.
And they are not wrong, those are popular numbers for a reason. But we don't need to get mystical about it. The numbers are less about magic and more about market convention and giving us a clear, multi-time frame perspective on the trend. For our Confluence method, we're going to use 3 EMAs. The 21 period EMA will be our short-term trend guide. The 50 period EMA will be our medium-term foundational trend line. And the 200 period EMA will be our long-term, is this a bull or bear market, line in the sand.
Okay, 21, 50, and 200. I'm putting them on my chart right now. Let's pull up, say, Bitcoin on the daily chart. What am I looking for? How do these 3 lines tell me a story?
The story is in their relationship to each other and to the price. It's a hierarchy. The healthiest, strongest uptrend you can find is when the price is trading above the 21 EMA, the 21 EMA is above the 50 EMA, and the 50 EMA is above the 200 EMA. They are perfectly stacked in bullish order. This tells you that the short-term, medium-term, and long-term trends are all in alignment, pointing up. Think of it like a river. The 200 is the riverbed, the 50 is the main current, and the 21 is the faster moving water on the surface. When they're all flowing in the same direction, you want to be swimming with the current, not against it.
I see it. Looking at Bitcoin from late 2020 to early 2021, it was exactly like that. A perfect, beautiful stack. Price would dip down, touch that 21 EMA, and then just take off again. So, the strategy here is to buy when the price pulls back to one of these EMAs in a clear uptrend.
That is the absolute core of the entry strategy, yes. We never want to buy an asset when it's miles above all its moving averages. That's chasing, and it's how you become what traders call exit liquidity for the smart money that bought lower. We wait for a return to a logical area of value. In a strong trend, the 21 EMA will often act as dynamic support. The price respects it. In a more standard, less parabolic trend, the 50 EMA is your bread and butter. A pullback to the 50 EMA in a confirmed uptrend is one of the highest probability long entries in trading.
And the 200 EMA?
The 200 EMA is the last line of defense. If a stock or crypto is in a confirmed uptrend, but it pulls all the way back to its 200 EMA, that's a sign of significant weakness. However, a strong bounce off the 200 EMA can be a tremendous buying opportunity, as it often marks the point of maximum fear and potential capitulation before the primary trend resumes. But for our main strategy, we're focusing on those pullbacks to the 21 and 50 in an established stat trend.
So what about the opposite? A downtrend. Let's look at something that's had a rough time. Maybe a stock like Peloton after its bubble popped. How would the EMAs look there?
It would be the exact inverse. You'd see the price trading below the 21 EMA, the 21 below the 50, and the 50 below the 200. This is a perfectly stacked bearish trend. In this scenario, you wouldn't touch that asset with a 10-foot pull for a long position. Instead, those EMAs become dynamic resistance. The price will try to rally, hit the 21 or 50 EMA, and then get smacked back down. These are your potential short selling opportunities, or if you're a long-term holder, your signal to be on the defensive or sell.
I see. And this is where those famous terms come in, right? The golden cross and the death cross.
Precisely. The golden cross is when the 50 period moving average crosses up and over the 200 period moving average. It's a powerful signal that the medium-term trend is strengthening and the long-term bull market could be starting. It's a lagging indicator, meaning it happens after the price has already bottomed, but it gives confirmation. The death cross is the opposite, the 50 crosses down below the 200. It's a sign that a major, long-term bear market could be underway. We saw a very famous one on the S&P 500 back in 2022. It doesn't mean you immediately sell everything, but it means the entire character of the market has changed. You stop buying dips aggressively and start respecting rallies as potential selling opportunities.
Okay, this makes perfect sense. Pillar 1 trend is established using the 21, 50 and 200 EMAs. We're looking for that clean stack formation and we're looking to enter on pullbacks to the 21 or 50. But here's my question. Sometimes the price pulls back to the 50 EMA and bounces beautifully. Other times it slices right through it like it isn't even there. How do we increase our odds of knowing which pullback is the one to buy? How do we measure the asterisk strength asterisk of that bounce?
An excellent question. And that brings us directly to pillar number 2, momentum. Just because the price has pulled back to a key level doesn't automatically mean it's going to hold. We need a way to gauge the underlying buying or selling pressure. Is the momentum of the trend still intact, or is it waning? For this, our tool of choice is the Relative Strength Index, or RSI.
Oh, the RSI. Another classic. Most people know it as the overbought/oversold indicator. It goes from 0 to 100. If it's above 70, the asset is overbought and due for a pullback. If it's below 30, it's oversold and due for a bounce. Is that how we're using it?
Yes and no. That is the textbook definition, and it can be useful, but using it that way in a strong trend can get you killed. In a powerful bull run, like we saw with Nvidia's stock in 2023, the RSI can stay in the overbought territory above 70 for weeks or even months. If you sold or shorted just because it was over 70, you would have missed one of the most explosive moves of the year.
So you're saying in a strong uptrend, overbought can just mean strong, and in a brutal downtrend, oversold can just mean weak.
Exactly. The context of the trend, which we established with our EMAs, is everything. So, we're going to use the RSI in a more nuanced, more powerful way. We're going to hunt for divergences.
Divergences. Okay, now we're getting into the advanced stuff. Break it down for me. What is a divergence?
A divergence is when the price of an asset is doing one thing, but the momentum indicator, our RSI, is doing the opposite. It's a massive clue that the underlying force of the trend is weakening. There are two main types, bearish and bullish.
Okay, let's start with bearish. Give me an example.
A classic bearish divergence occurs in an uptrend. Imagine a stock makes a new high. The price on the chart is higher than the previous peak. But when you look down at your RSI indicator, the peak on the RSI is asterisk lower asterisk than the peak it made during the previous price high. Price is making a higher high, but RSI is making a lower high. This tells you that the momentum behind this new price high is weaker than it was for the last one. The rally is running out of steam. It's a warning sign that a reversal or a significant pullback is becoming much more likely.
Well, okay, that's a powerful concept. It's like a car is still moving forward, but you can hear the engine sputtering and losing power. So if we were in a long position and we see a bearish divergence forming, that might be our signal to take some profits off the table.
Precisely. It's an exit signal. It doesn't mean you immediately panic and sell everything, but it means the risk/reward of staying in the trade has shifted. The party might be winding down. You might tighten your stop loss or sell a portion of your position to lock in gains. It's a proactive signal that lets you get out before the crowd does.
And the flip side? A bullish divergence?
The exact opposite, and it's our key signal for entering a trade. Let's go back to our primary setup, a strong uptrend with stacked EMAs. The price is pulled back, maybe it's approaching the 50 EMA. Now, during this pullback, the price makes a new low on the chart, a lower low than the previous dip. But you look down at your RSI, and the RSI has made asterisk high or asterisk low. Price is making a lower low, but RSI is making a higher low. This is a bullish divergence. It's telling you that even though the price is dropping, the selling momentum is drying up. The bears are getting exhausted.
I get it. So we have our context, a beautiful stacked EMA uptrend. We have our location, a pullback to the 50 EMA. And now we have our trigger, a bullish divergence on the RSI as the price hits the 50 EMA. The engine that was driving the price down is stalling out, right at a key support level.
Now you're seeing the confluence. It's not just one signal. It's three things happening at once. The long-term trend is up. The price has returned to a logical area of value. And the short-term selling momentum is evaporating. The probability of a bounce from that level is now significantly higher than if you had just bought the level blindly.
This is a huge piece of the puzzle. It helps you filter out the weak setups from the strong ones. Let's talk about a real-world example. Has there been a recent chart where this played out clearly? Maybe on Ethereum or a major tech stock?
Absolutely. Let's look at a chart of Microsoft throughout 2023. It was in a clear, sustained uptrend with the EMA stacked beautifully on the daily chart for most of the year. There were several pullbacks to the 21 or 50 EMA. On a few of those key pullbacks, you can see the price dip to make a slightly lower low on an intraday basis, but the RSI prints a clear higher low. Those points were textbook entry points for the next leg up. It allowed you to buy the dip with confidence, because you had the trend on your side and momentum confirming the potential bottom of the pullback.
Man, that's a game changer. It transforms the RSI from a simple overbought/oversold meter into a sophisticated tool for spotting trend exhaustion and continuation. Okay, so we have Pillar 1, trend via EMAs. Pillar 2, momentum via RSI divergence. What's the third and final pillar?
The third pillar is confirmation. It's the final check. And for that, we use the oldest indicator in the book, volume.
Alt volume. The number of shares or contracts traded in a given period. It's usually just sitting there as little bars at the bottom of the screen. I feel like most people ignore it.
And that's a massive mistake. Volume is the fuel that drives price moves. A price move without volume is suspicious. A price move asterisk with asterisk massive volume is significant. It tells you there is conviction and participation behind the move. Tom DeMark, a legendary market technician, had a great saying, price is the arrow, volume is the bow.
Price is the arrow, volume is the bow. I like that. So how do we incorporate it into our Confluence method? We're at our pullback point, we see the bullish divergence. What are we looking for in the volume bars?
Let's walk through the sequence. First, as the price is pulling back to our key EMA, we ideally want to see the volume decreasing. This is called a dry up in volume. It suggests that there isn't a lot of aggressive selling pressure pushing the price down. The sellers are not enthusiastic.
Okay, so we're quiet. Orderly pullback is better than a panic sell-off on huge volume.
Exactly. A panic sell-off could break right through our support level. So, we see the price pulling back on declining volume. It touches the 50 EMA. The RSI is showing our bullish divergence. Now, we wait for the bounce. And as the price starts to move up off that EMA, we want to see a significant asterisk increase asterisk in volume. We want to see a big, green volume bar that is noticeably larger than the preceding red bars.
So that's a confirmation. The big money is stepping in. That surge in volume on the bounce tells us that buyers are aggressively taking control at that level. It validates the support level, it validates the RSI divergence, it validates the whole trade idea.
That is the trifecta. That is the A+ setup. Trend is aligned. Momentum is turning. And volume is confirming the new buying pressure. When you see all three of those things line up on a chart, that is a trade you can take with a high degree of confidence.
Okay, let's put it all together. Walk me through the perfect long trade, step by step, using the Confluence method.
Step 1. Time frame analysis. We look at the daily chart. Are the 21, 50, and 200 EMA stacked in a clear bullish formation? Is the price trading above the 50 and 200? If no, we close the chart and look for a different asset. We do not proceed. If yes, we move to step 2.
A strict filter. I love it. No trend, no trade.
Step 2. Identify the location. We wait for the price to pull back to a key area of value, which for us is a 21 or 50 EMA. We do not chase the price when it's extended. We let the opportunity come to us.
Patience. The hardest part for most traders.
Step 3. Look for the trigger. As the price approaches our EMA, we watch the RSI. Are we seeing a bullish divergence form? Is the RSI making a higher low while the price makes a lower low? We also look at the volume. Is the volume drying up during the pullback?
So we're stuck in the trade. We're waiting for all the pieces to fall into place.
Step 4. The entry. The price touches the EMA. It starts to bounce. We see that first big green candle form, and crucially, we look down and see a spike in volume confirming the bounce. That is our signal to enter the trade. We place our buy order.
Boom. We're in the trade. Everything lined up. But now what? This is where so many people get it wrong. They find a great entry, and then they either sell too early for a tiny profit or hold on forever until it comes all the way back down and stops them out. How do we manage the trade once we're in it?
This is, without a doubt, the most important part of the entire discussion. You can have the best entry system in the world, but if you don't have a rock-solid plan for risk management and trade management, you will fail. It's a mathematical certainty.
So let's talk about the non-negotiables. What's the first thing we do the instant we enter a trade?
We set a stop loss. Immediately. Without hesitation. A stop loss is a predetermined order that will automatically sell your position if the price goes against you and hits a certain level. It is your ultimate protection. Trading without stop loss is like driving a race car without brakes. You might be fine for a little while, but eventually you're going to hit a wall and it will be catastrophic.
So where do we place the stop loss for our setup?
Logically, it has to be placed at a point that invalidates our trade idea. If we bought the bounce off the 50 EMA, our trade idea is that the 50 EMA will hold as support. Therefore, our stop loss should go just below the low of the candle that touched the EMA, or for a bit more room, a measured distance below the 50 EMA itself. If the price goes down and hits that stop loss, it means our thesis was wrong. The support didn't hold. We accept the small, managed loss and we move on.
A small, managed loss. That's the key. You're defining your risk before you even think about your potential reward. So let's say we bought a stock at $100, bouncing off a 50 EMA. The low of the bounce candle was $98. So we might set our stop loss at $97. 50. We are risking $2. 50 per share.
Exactly. Now, the second part of risk management is position sizing. This is what separates amateurs from professionals. Your position size is determined by your stop loss, not the other way around. Most people do it backwards. They say I want to buy 100 shares, and then they just accept whatever the risk is. That's how you blow up.
Okay, break down the professional way. How do we calculate the correct position size?
You start with your total trading capital. Let's say you have a $10,000 account. A standard professional rule is to never risk more than 1% to 2% of your account on a single trade. Let's be conservative and use 1%. So, on your $10,000 account, the maximum amount you are willing to lose on this one trade is $100.
Okay, so my total dollar risk is defined, $100.
Now, you look at your trade-specific risk, which we just defined with our stop loss. It was $2, 50 per share. To calculate your position size, you simply divide your maximum dollar risk by your per share risk. So, it's $100 divided by $2. 50. That equals 40. Your correct position size for this trade is 40 shares.
Well, okay, let's trace that. If I buy 40 shares at $100 and it goes down to my stop loss at $97, 50, I lose $2. 50 per share on 40 shares. 40 times $2. 50 is exactly $100. I lose exactly 1% of my account.
Correct. See how that works? If your stop loss was tighter, say only $1 away at $99, then your position size would be $100 divided by $1, so you could buy 100 shares. If your stop loss was wider, say $5 away at $95, your position size would be $100 divided by $5, so you could only buy 20 shares. The position size adjusts to ensure your risk is constant. This is the holy grail. Not the entry signal, but this concept of consistent, managed risk. It keeps you in the game. You could be wrong 10 times in a row and you'd still have 90% of your capital to keep trading.
My mind is officially blown. That single concept is worth the price of admission. Okay, so we have our entry. Our stop loss is set, our position size is correct. Now, what about the fun part? Taking profits. What's the strategy?
There are a few schools of thought here, but a great place to start is with a fixed risk/reward ratio. You know your risk is 1 unit the distance from your entry to your stop loss. A good goal is to aim for a profit target that is at least twice your risk, a 1:2 risk/reward ratio.
So in our example, our risk was $2, 50 per share. So we would be targeting a profit of 2 times that, which is $5 per share. Our profit-taking order would be at $105.
Exactly. You can place a limit order to sell at $105 right after you enter. This creates a fully automated trade. You have your entry, your automatic stop loss for protection, and your automatic profit target. You can set it and walk away, removing emotion from the equation. A 1:2 ratio is a good minimum. If you can find trades with a 1:3 ratio, even better. The beauty of this is that you only need to be right 34% of the time to break even with a 1:2 ratio. If you win 40% or 50% of your trades, you are significantly profitable over the long run.
That's the math that makes a career. What about other exit strategies? What if the stock blows right past our $105 target?
A more advanced technique is to use a trailing stop. For example, once the trade moves in your favor, you could sell half your position at the 1:2 target to lock in profit, and then move your stop loss on the remaining half to your entry price. This is now a risk-free trade. The worst that can happen is you get stopped out at break-even. You then let the second half run, trailing your stop loss up under the key EMAs, like the 21 EMA. You ride the trend until the trend breaks, capturing a much bigger move if it happens.
I like that. A hybrid approach. Pay yourself first, then let the rest ride. It satisfies both the need for security and the desire for that home run trade. Okay, Cooper, this is an incredibly comprehensive system. It's logical, it's rules-based, it covers entry, exit, and risk management. Now for the million-dollar question you posed at the beginning. You said this works for both stocks and crypto. Is it really that simple? Can I take this exact system and apply it to Solana tomorrow?
It is that simple, but with a few crucial adjustments for the differences in market personality. The underlying principles of trend, momentum, and volume are universal because they are reflections of human herd behavior, which is the same whether people are trading stocks or JPEG of rocks. But the environment changes.
What's the biggest difference we need to account for? Volatility.
Volatility is number one. Crypto is significantly more volatile than most stocks. A 10% move in a single day is common for Bitcoin. For a stock like Johnson & Johnson, that would be a world-shaking event. What this means in practice is that you may need to use wider stops, in percentage terms. A tight stop that works on a utility stock will get you shaken out of a crypto trade instantly.
But wait, if we use a wider stop, doesn't that mess up our risk management? If our per share risk is bigger, our position size has to be way smaller, right?
Precisely. And that's the adjustment you must make. To maintain your 1% account risk rule, your position size in a volatile crypto asset will naturally have to be smaller than in a stable blue chip stock with the same trade setup. This is how you tame volatility. You don't try to predict it, you adjust your exposure to it.
That makes sense. What's another key difference? The 24/7 nature of crypto.
Yes, the crypto market never sleeps. This means that using the daily chart is still great for the overall trend, but a lot of the actionable setups will happen on low timeframes, like the 4-hour or even the 1-hour chart. The principles of the Confluence Method work on any time frame, but you have to be aware that the lower you go, the more noise there is and the more frequent the signals become. A setup on the 1-hour chart is less significant than the same setup on a daily chart.
So for a stock trader who works a day job, using the daily chart is perfect. They can analyze it in the evening, set their orders, and not have to stare at the screen all day. For a crypto trader, the 4-hour might be a better balance of frequency and signal quality.
You've got it. The last minor difference is volume. For a stock traded on the Nasdaq or NYSE, the volume data is centralized and accurate. For crypto, volume is fragmented across dozens of exchanges. When you're analyzing volume for a crypto asset, you want to make sure your charting software is pulling data from a high liquidity exchange like Binance, Coinbase, or Bybit. The volume there is a much better representation of the overall market activity.
So, to recap the adaptation, the core strategy remains identical. But for crypto, we must use smaller position sizes to account for higher volatility. We might focus more on a 4-hour chart for our signals, and we need to be sure we're looking at a reliable volume source.
That's the perfect summary. The system is robust because its foundations are universal, but you have to be intelligent in how you apply it to different environments.
Cooper, this has been an absolute masterclass. We've built a complete trading system from scratch. We started with the problem of noise and indicator overload. We defined a solution, the Confluence Method, based on 3 pillars: trend using the 21, 50, and 200 EMAs, momentum using RSI divergences, and confirmation using volume. Then, most importantly, we wrapped the entire thing in a bulletproof shell of risk management, defining our risk with the stop loss and calculating our position size based on a 1% rule. We even covered how to adapt it for different markets.
The goal was to provide a clear, logical, and repeatable process. Trading success isn't about finding a magic bullet. It's about having an edge, however small, and applying it with discipline over and over again. This method gives you a statistical edge. Your job as a trader is to execute it flawlessly, which means respecting your stop losses, managing your emotions, and not deviating from the plan. The biggest enemy is usually the person staring back at you from the screen.
So true. The psychological battle is the final boss. You can have a perfect plan, but if you're hit with a string of 5 losses in a row, which will happen, even with a great strategy, and you abandon the plan out of frustration, you've lost.
That's why the risk management is so critical. After 5 1% losses, you've lost 5% of your account. That's a recoverable drawdown. You're still in the game. If you were risking 10% per trade, you'd have lost half your capital. That is a psychologically devastating and financially crippling blow. Your system has to be designed to withstand the inevitable losing streaks.
What would be your final piece of advice for someone who's listened to all this, is excited, and wants to start applying it today?
Do not risk a single dollar of real money yet. Open a free trading view account. Put the 3 EMAs in the RSI on a chart of an asset you like. Go back in time. Scroll through the chart day by day and practice identifying the setups. This is called backtesting. Find the stacked EMAs. Find the pullbacks. See if there was a divergence and a volume spike. See where you would have entered, where your stop would have been, and where your 1-2 profit target was. Do this 100 times. Get a feel for the rhythm of the strategy. Then, and only then, should you consider trading it with a very small amount of real money. Prove to yourself that you can follow the rules.
Backtest, then pay per trade, then trade small. Walk before you run. Incredible advice. Well, that's all the time we have for today, folks. I hope you got as much out of this as I did. This was a true deep dive into what makes a trading strategy actually work in the real world.
It was a pleasure, Murph. Remember everyone, this is a marathon, not a sprint. Keep learning, stay disciplined, and manage your risk above all else.
You heard the man. If you found value in this discussion, do us a huge favour and hit that like button, subscribe so you don't miss our next episode, and drop a comment below. Let us know if you use a similar strategy or if you have any questions about the Confluence Method. We read every single one. Thanks for tuning in, and we'll see you in the next one.